Hey there, Jeff Hughes from Grain IQ. Wanted to recap the market this week. It's Friday afternoon, May 21st. Couple important facts and then some insights into how that might impact your grain marketing positions as a farmer. So first, corn side of the house, we saw China buy over their double their normal volume of new crop purchases coming in at 3.75 million tons. This helped to reduce the amount that corn prices fell from the hedge funds racing for the exits here over this last week. On the soybean side, no surprises here. We expected to see low volumes of new sales, and that's exactly what we got. On the corn side, export numbers are super important right now as the bull thesis is incredibly dependent upon strong exports. In soybeans, vast majority of market participants expect that the export demand is going to be weak at these current prices, but given how low ending stocks are, it's not actually impossible to see us import beans. I know the ADM did a cargo load from Brazil not too long ago. But on the important side of stories this week, we got to see something kind of unique happen that doesn't normally happen, which I think does a really good job of illustrating the importance of understanding how fund concentrations impact prices. So this week we saw, if you weren't watching the news, the I-40 bridge over the Mississippi River that goes through Memphis had a beam snap, which shut down all the barge traffic. It's created a really unique situation where you had the potential to see a force majeure, or here in the U.S., an act of God provision in the contracts where buyers would be able to cancel them due to an unforeseen circumstance where the barges couldn't get down the river to deliver at port. When we see this, if the effect of those sorts of events is negative, it can actually cause buyers to cancel their orders, try and buy them back or refill them at a cheaper rate, and therefore save some cost. Now, typically, something along these lines wouldn't move the markets a tremendous amount. However, this is where fund concentration is super important. Where we see 400,000 long contracts coming in from speculators at the beginning of the week, as soon as we started to see a little bit of bearish news, something that would have otherwise dropped the market 10 cents, we saw from May 7th all the way down to today a drop of nearly a dollar of 90 cents from, say, mid 630s highs down to 548 here about midday. That's important to illustrate as we still expect funds to be fairly long, and should we get any more bearish news, whether it's a revision upward in acres or adequate rainfall throughout the Midwest to improve growing conditions, those bear stories can amplify our descent throughout the rest of our growing season here for new crop 2021 corn and beans. So what does this mean for you all? If you're a farmer, I would be thinking about the following things. We've seen basis strengthening from export demand. It'll likely end up weakening in 2020 or old crop corn, but we don't see this spilling much into new crop corn for 2021. Also, I know it's uncomfortable and unfun to sell into a crash. Being disciplined is tremendously important. So the bull thesis last week from all of the speculators, right, changed massively just from something small like a bridge outage. So that creates this very fragile euphoria that we've experienced in this massive rally, where if we have any sort of positive weather stories or talk of larger plantings, could worsen the sell-off, and that could bring us down back into the fours potentially. Secondarily, the other thing to be thinking about is that soybean is getting pulled down by corn due to them being highly correlated. However, because we have such tight stocks in soybean, the downside risk is tremendously limited, and should we get bad weather in August, we're likely to see that spike back up. So what I would be considering if I was in a farmer's shoes today would be to pay attention to your potential yields as the season is starting to get into full swing, and have a safe amount of your corn marketed to take a considerable amount of risk off the table, especially if it's bushels you don't have storage for. Roughly 50% would be a good mark, but a little more or a little less, depending upon your personal risk tolerance, would be just fine. And then on our side of the house, we're holding on to that soybean risk. As always, if you have any questions, feel free to give us a call, shoot us an email, or contact your local representative, and we will talk soon.